in 2008 to 2016, they were caught spoofing the gold, in the silver market. And they got fined $992 million.
I think this is one of the things that's going to be so beneficial, Pete, is about this documentary. It's going to touch people that don't know any of this stuff. It's not because they're illiterate. It's simply because, as you just said, mainstream media does not focus on any of this stuff. So one of the first things that drew my attention to what I was so pleased to see, how you draw attention to how Wall Street has enormous leverage over the regulators. And if they've got leverage over the regulators, it kind of says we the people are supposed to accept that when the too big to fail taxpayer funded banks, taxpayer funded by us, when they get it wrong, like in 2008, which you refer to, it's okay to socialize the debt. And even though any profit they would have done earned would have been privatized. And we're not talking about small amounts, we're talking about tens of trillions here. So if anyone thinks, but that was a bailout, and I'm going to ask you a little bit more about this, but if anyone thinks that bank bailouts have stopped, you just have to look at the bailout JP Morgan and a couple of too big to fail liquidity providers received just less than 4 months ago when the nickel market blew up. Now, I know you're a silver addict here. We're all silver addicts here. Shane is going to be, when he introduces these programs, you can see silver in his eyes. But basically, we're talking about something that leads into silver here, because what happened was when the nickel market blew up in these too big to fail banks' faces, exposing them to billions of losses. In this case, the regulators, the officials were able to ring fence these losses as it was contained in this little market called this LME. But now we see these liquidity providers, JP Morgan and others, racing to exit the silver market because before it does go nickel and blow up in their faces. The only difference is, Pete, as we know, silver is a foreign exchange cross. It's not just some base metal trading in this siloed little world. So it cannot be ring-fenced in the same way. When you're long silver, you're short the dollar. When you're long the dollar, you're short silver. So it's a foreign exchange cross. You cannot ring-fence it. So what I'm suggesting is, Pete, tell these sharks to come in. There's blood in the water, my friend.
Yeah, certainly the thing that's really nefarious is, insider trading, which is prevalent. And then you talk about JP Morgan. So JP Morgan, the 5 felony bank, Jamie Dimon is more, I think he's got, at least 5 felonies, and the board has never, let him go or demanded they have a new CEO. In 2008 to 2016, they were caught spoofing the gold, in the silver market. And they got fined $992 million. But nobody goes to jail. It appears on Wall Street it's just the cost of doing business. In 2008, Goldman sold the housing market short as they were selling it long to their clients. Respectfully, that's a nefarious act, because here you have your brokers saying, hey, this is good, and then you're taking the other side of the position. And again, they got fined $500 million. I think they profited about $1.5 billion. So they got paid well for the cost of doing business. And here's the question: the fines that are given by the SEC, who I call the captured regulator, they don't go to the people that got defrauded. They go to the government. So the people get screwed several times. Hey, Goldman did, or any financial organization that has been caught, with their finger in the cookie jar. Very seldom, do they, get incarcerated. Most of the time, they just get paid fines. But the people, sometimes they get their capital back, but not much unless there's suits, as in Robin Hood. Let's talk about that a little bit. So, Robinhood being a mobile trading app, in the situation where you have GameStop, So the market maker is Citadel, and a market maker, for all the people out there, is someone who executes the buys and the sells, but they pay for something called order flow, and they gave Robinhood about 142 million for the privilege of trading and being the market maker, for GameStop and other positions, other companies. So they get to witness on a day-to-day basis or a second basis the buys, the sells, the shorts, the longs, the volume, and the derivatives or the options on the long and the short side. With that information, you could front run the market and make hundreds of millions of dollars. And if they did that, that would be against the law. And people should also take note that Bernie Madoff, when that Ponzi scheme came down, before it came down, the SEC had 6 substantive complaints. They did nothing. Gensler, or the only one that did anything was Bart Chilton. Any other, CFTC chairman, they really turn a blind eye, to the basically naked shorting on the LBMA when they have the leverage at 100 to 1, selling one contract to 100 people. And then the bottom line, if they take delivery, they can't do that. But as you know, with Basel III rules, that has changed. However, the commercials are still, playing their games in the marketplace. It's a very interesting scenario that you have going on. I mean, the 10-year chart shows commercials covering gold short positions from on the latest takedown, in the gold market. And that's on a longer chart, a 10-year chart. The multi-decade chart shows that the gold short positions are back in neutral positions. But however, in the silver chart, it's completely different. The commercial traders are now one of the most bullish positions in the last decade. So I believe there's going to be a rebound in silver in short order. But it's really interesting. People in the mainstream news are saying the commodities market or gold are going down because they got a high read in inflation. That's so counterintuitive. You got a high read in inflation, and real negative interest rates. That's the environment historically where gold and silver blows up. Then you have Bitcoin, which has been untested, which technically it is a good instrument because it's finite, meaning there's only a certain amount and that's it. If they had gold and silver, it was finite, or the U.S. monetary supply, if that was finite, we'd have a strong dollar. So, and Bitcoin hasn't been tested. It's been, pretty much following the Nasdaq. But now, it seems to be decoupling a little bit. It's trading at 22,000, and I don't think a lot of people understand the technology. And I've been a gold and silver bull for a long time, but I'm really fascinated. I'm going to tell you, I'm really fascinated with Bitcoin. A lot of people in the gold world aren't, Peter Schiff and everybody, but I think that the technology should be studied, and I think there's a base case, and that's what I'll say about that, for now. But I will say that it's, in this particular environment where you have, it's not runaway inflation yet, but then you have these problems of easy money, or like heroin that they had for the last 12 years that really was prolificated by poor monetary policy and by the Federal Reserve Bank. And since 1913, the U.S. dollar has been devalued or depreciated 98%. And in that same period of time, the interest rates have been in between 1 and 21%. So for the Federal Reserve to be given a job by our Congress, they're supposed to promote or stable interest rates and a strong dollar or a strong fiat, strong currency. They failed miserably. And since Nixon took us off the gold window in 71 at Bretton Woods, the dollar's depreciated another 98%. Now our dollars are backed by the good old faith of the U.S. government, which is perpetually bankrupt. So this is a very sordid situation that we're in. Then you had the hundreds of thousands of businesses closed for COVID, from March of 2020. And a lot of those companies stayed out of business, and that's not reflected on Wall Street. It's again a wealth transfer, from the middle class to the 1% or the oligarchical class. Like 2008 was a big wealth transfer, and the wealth transfer in 2008 was again due to deregulation and poor monetary policy. Greenspan was a proponent of deregulation. 1999, Clinton and Phil Gramm took us off Glass-Steagall, allowed banks to act as casinos or act as broker dealers with depositors' money. Instead, banks were designed as a utility, simple interest, certificates of deposit, real estate loans, a safe place to keep your money. And people should know from 1933 to 1999, there was never a banking issue. There's only a savings and loan issue, but not a banking issue. So now you go off Glass-Steagall. And Bill Clinton doesn't agree with what I'm about to say, is that, I actually believe that Glass-Steagall was set the stage for a financial crisis. He doesn't think so. When you're trying to say that you're stymieing business, well, I think it was a Travelers, Insurance City deal that they wanted to merge, and that Glass-Steagall would have prevented that. But you're not thinking about how the banking system works, because if you're allowing Bank of America to act like Goldman Sachs and then lever themselves 30 to 45 to 1, that's a recipe for disaster. And I remember Meredith Whitney going into Lehman Brothers and saying you need to raise capital, and then three different times, Dick Fuld, John Thain from both company, him and Bear, they decided to say they were fine, and they didn't, and those companies end up blowing up. But when a CEO hangs his hat on what he's saying, we're good, the stock's trading at $20 and we don't need to raise capital, so people think, well, I got a 60% discount on the price, and they put millions of dollars in it and the price goes to under $4, you're gonna lose money.